Markets are not driven by logic. They're driven by people. And people are predictably irrational. Quick summary. Investor psychology is the hidden force behind every market boom, bubble, and crash. Behavioral finance reveals how biases, emotions, and crowd behavior shape financial decisions. Understanding fear, greed, and overconfidence is more valuable than any spreadsheet model. Great investors aren't emotionless. They're self-aware. The market's biggest risk isn't volatility. It's our reaction to it. 1. What is investor psychology? Investor psychology explores how human behavior, emotion, and cognitive bias influence financial decisions. Traditional finance assumes that investors are rational, that they weigh information objectively and make decisions that maximize profit. But real life proves otherwise. When markets crash, rationality disappears. Fear spreads faster than logic. When markets rally, greed blinds judgment. That's where behavioral finance steps in, a field combining psychology and economics to explain why even smart investors make irrational choices. Why it matters? It explains why bubbles form, even when valuations make no sense. It shows why investors sell good companies too soon and hold losers too long. And it helps analysts predict how markets react to news, not based on numbers, but on emotion. 2. The battle between rational and emotional minds. Investing is a constant tug-of-war between the rational brain and the emotional brain. Rational thinking, logical, data-driven, analytical. Emotional thinking, impulsive, intuitive, reactive. Focuses on long-term fundamentals, obsesses over short-term price moves. Seeks opportunity in fear, panics in uncertainty. Calm during volatility, exhilarated by greed, crushed by loss. The truth is, even seasoned investors struggle to stay rational. Market volatility amplifies emotions, turning data into drama. Successful investors aren't those who feel nothing. They're those who recognize their feelings and prevent them from hijacking decisions. 3. The biases that control your portfolio. 3-1. Overconfidence bias. You think you're smarter than the market? So does everyone else. Overconfidence makes investors overestimate their ability to time markets, trade too frequently and lose to fees and taxes, concentrate portfolios into a few sure things. It's why, despite the data, most active investors underperform index funds. 3-2. Availability bias. We tend to give more weight to the most recent or most vivid information. A recent rally makes us think markets only go up. A scary headline convinces us a crash is coming. This bias drives short-term thinking, ignoring deeper fundamentals like cash flow or intrinsic value. 3-3. Representativeness bias. We stereotype investments based on patterns we think we see. If it looks like Tesla, it'll perform like Tesla. If it's cheap, it must be a value play. Reality, every stock has a unique story. Past winners don't guarantee future success. 3-4. Self-attribution bias. When we win, it's because we're brilliant. When we lose, it's the Fed's fault or bad luck. This bias prevents honest reflection, the only thing that improves performance. 4. Market sentiment, the mood of the crowd. Markets are emotional ecosystems. To measure the crowd's mood, analysts use sentiment indicators. Fear and greed index. 0. Extreme fear. Investors panic, selling everything. 100. Extreme greed. Euphoria. Everyone's buying. Smart investors do the opposite. Buying fear, selling greed. Investor confidence surveys. Tools like the AAII Sentiment Survey measure optimism versus pessimism among retail investors. When bullish sentiment is at extremes, it's often a contrarian signal. Technical indicators. Charts often mirror psychology. RSI shows overbought or oversold emotional extremes. MACD and volume reflect conviction or hesitation. The data may be mathematical, but what it reveals is behavioral. 5. The hidden biases that sabotage you. 5-1. Loss aversion. We hate losing money twice as much as we enjoy making it. That's why we hold on to losers hoping they'll recover. We sell winners too soon to lock in gains. Loss aversion creates the disposition effect, one of the most documented traps in finance. 5-2. Confirmation bias. We only read what agrees with us. We Google why Nvidia will double instead of risks of Nvidia stock. This echo chamber inflates overconfidence and blinds us to danger. Smart investors read both the bull and the bear case. 5-3. Anchoring effect. We fixate on old price points. I'll sell when it gets back to 1,000 rupees. Anchoring stops us from adapting when fundamentals change. The stock doesn't care what price you bought it at. 5-4. Herd mentality. When everyone's buying, we feel safe buying. When everyone's selling, we feel safe selling. That instinct once kept our ancestors alive. In markets, it destroys wealth. The crowd creates bubbles and crashes. The contrarian quietly profits. 6. Emotional traps. FOMO, FUD, and the sunk cost fallacy. Fear of missing out. You see a stock up 30% in a week. Your brain screams, buy now. FOMO pushes investors into overvalued assets, creates bubbles, crypto 2021, AI 2023, destroys long-term strategy discipline. FUD, the opposite of FOMO. Bad headlines trigger panic selling, often right before recovery. Both FOMO and FUD make investors react instead of plan. Sunk cost fallacy. I've already lost too much to sell now. That mindset turns small losses into portfolio sinkholes. Good investors cut losers early. Capital doesn't have feelings. 7. Risk perception and tolerance, the DNA of decision-making. Every investor has a different threshold for risk. Risk aversion prefers stability and predictability, buys dividend stocks, bonds, and blue chips, avoids volatility, sometimes too much. Risk-seeking chases high reward despite uncertainty, buys growth stocks, emerging markets, and speculative assets, can win big or lose big. The key is alignment. Your portfolio should match your psychological comfort zone, not someone else's. Prospect theory in action. Developed by Daniel Kahneman and Amos Tversky, prospect theory explains that we feel losses more than equivalent gains. We overvalue small probabilities, like lottery stocks. That's why penny stocks and options attract emotional money.
8. Information overload and decision paralysis. Modern investors drown in data, financial statements, news alerts, social media chatter, analyst reports. Too much information doesn't lead to better decisions, it leads to confusion. When overwhelmed, we rely on shortcuts, or worse, freeze completely. Common traps. Recency bias, obsessing over the latest news instead of long-term trends. Selective attention, reading only bullish or bearish takes that fit our view. Decision fatigue, giving up on research and just following the herd. Great investors like Buffett solved this by focusing only on high-signal, low-noise data, the few things that truly matter. 9. Decision-making under uncertainty. Investing is never about certainty, it's about probability. Probability weighting. We overweight tiny chances of big wins, like this could be the next Apple. That's why speculative trades feel thrilling, even when odds are terrible. Ambiguity aversion. We prefer known risks like domestic stocks over unknowns like foreign markets. That's why most investors suffer from home bias, missing global opportunities. Framing effects. How information is presented shapes perception. 90% survival rate feels safer than 10% mortality rate. Likewise, record profits hides slowing growth. Smart investors reframe data objectively before reacting. 10. Investor personality types. Knowing your personality profile is like knowing your investment DNA. Type: conservative. Characteristics: cautious, income-focused, value safety. Typical mistake: misses high-growth opportunities. Aggressive: high risk tolerance, chases returns, overtrades or ignores downside. Value investor: seeks undervalued companies, gets trapped in value traps. Growth investor: pursues innovation and future potential, pays too high a price. Active trader: times markets, analyzes patterns, emotional burnout, short-term bias. Passive investor: index fund believer, may ignore rebalancing needs. No one type is best, but self-awareness defines success. 12. Market cycles and collective psychology. Markets move in emotional cycles: optimism, excitement, euphoria, bubble forms, anxiety, denial, fear, panic, crash begins. Capitulation, despair, hope, recovery, cycle resets. Every bull market ends in overconfidence. Every bear market ends in exhaustion. Those who understand this rhythm profit from it. Bubble formation psychology. Driven by narratives, not numbers. Investors rationalize irrational valuations like, this time it's different. When reality hits, bubbles burst and fear overshoots in the opposite direction. Panic selling. Fear triggers liquidity rushes. Everyone wants out, few want in. Contrarians step in, buying assets on sale. As Buffett says, be fearful when others are greedy, and greedy when others are fearful. 13. The contrarian mindset. Contrarian investing is the ultimate psychological test. It means buying when the crowd mocks you and selling when they cheer. To succeed, separate fact from narrative, measure sentiment extremes, build conviction based on fundamentals, not emotions. Contrarians don't predict tops or bottoms, they exploit excess emotion. 14. Behavioral finance in real investing. Strategy development. Behavioral finance shapes momentum and value strategies that exploit collective biases. Risk management systems that minimize emotional overtrading. Sentiment analysis models tracking news tone, volatility, and social chatter. Portfolio management. Rebalancing prevents emotional drift. Diversification protects against bias-driven concentration. Behavioral coaching keeps investors aligned with long-term goals. Financial advising. Good advisors are part psychologist, part strategist. They educate clients on biases, they use framing to clarify risk versus reward, and they implement commitment devices like automatic rebalancing to enforce discipline. 15. How to become a more self-aware investor. Keep an investment journal. Track not just trades, but your emotions at the time. Patterns will emerge. Use checklists. Define rational criteria before buying or selling. Limit information intake. Curate high-quality sources. Mute the noise. Review performance quarterly, not daily. Detachment builds objectivity. Embrace humility. The market exists to teach you patience, not perfection. 16. The future of investor psychology. As AI and algorithmic trading dominate volume, one might assume human emotion matters less. Wrong. Algorithms amplify human bias at scale because they're coded by humans. The inputs, earnings expectations, sentiment feeds, click-driven news are still emotional. Investor psychology will remain the most powerful, invisible hand shaping markets. The winners will be those who understand behavior as deeply as balance sheets. 17. Key takeaways. Concept, impact on investors, how to counter. Overconfidence leads to overtrading. Use data-driven benchmarks. Loss aversion, holding losers too long. Focus on opportunity cost. Confirmation bias, ignoring risks, seek opposing views. Herd mentality, following the crowd, define your own thesis. FOMO or FUD, chasing tops or panicking at bottoms. Automate investing. Anchoring, stuck on old price levels. Re-evaluate fundamentals. Recency bias, overweighting recent news. Zoom out to long-term trends. 18. The real edge in markets. Everyone has access to the same data. Few have control over their emotions. That's your edge. The best investors aren't those who know the most, they're those who react the least. They understand that volatility is not a signal of danger, but an expression of human psychology in motion. The next time the market dips or rallies, don't ask what happened, ask what are people feeling? Because in the end, markets are mirrors reflecting not just numbers, but us.